Hey everyone, thanks for joining us for this month's Intro to Fundraising and Ask Me Anything event. My name is Jake O'Shea. I'm Capital Factory's Investor Relations Manager, leading our investor relations team and helping founders craft and execute on their fundraising strategy. What I love about this event is that it gives us all the chance to do a deep dive with an investor together to help better understand their thought process when evaluating companies for investment and hopefully help you guys in the audience be more successful in your own fundraising endeavors. Today, we're speaking with Matt Harris, a member of the investment team at Draper Associates. Before we start, we have Capital Factory founder and CEO Josh Baer here to say a couple of words. Take it away, Josh.
Capital Factory is the center of gravity for entrepreneurs in Texas. Thousands of entrepreneurs, programmers, and designers gather day and night, in person and online, for meetups, classes, and co-working. And with our team spread across the state in Austin, Dallas, Houston, and San Antonio, we meet all the best entrepreneurs in Texas and introduce them to the people that they need to meet most: investors, customers, and talent to grow their team. We watch all of this happen so that we have this unique insight into the market and use that to invest in all the best companies through our Texas Fund. And we've been the most active early stage investor in Texas since 2010.
Awesome. Thanks so much, Josh. It's always good to hear from you about Capital Factory. I think the other thing I want to touch on is the Texas Startup Manifesto, which is really kind of the thesis that informs everything we do here at Capital Factory and really drives our activity. The Texas Startup Manifesto is essentially the argument or the idea that taken individually, it's really difficult for Houston, Dallas, Austin, San Antonio to compete with some of the bigger startup hubs across the country. Places like San Francisco, Silicon Valley in general, or just the whole East Coast, New York City specifically. But when taken together, that's 4 of the top 10 largest cities in America. Taken together, Texas represents the 9th largest economy in the world. And really, if we can kind of build infrastructure and help companies that are founded in Houston hire talent from Dallas and raise capital from Austin, and really just think of Texas as one big startup ecosystem, it can rival any other startup ecosystem in the world. So that's kind of how we think about Texas, why we're hyper-focused on Texas. And, really, I think that ties in really well to kind of Matt Harris, who we're going to be talking to today, because Matt kind of leads the Texas and really regional focus for Draper Associates and their fund down here. So now I'd like to give a little bit of a brief introduction on Matt before we bring him up on stage. So Matt Harris is on the investment team at Draper Associates. Like I mentioned, he's got the regional focus on deal flow from Texas in this area. Matt joined the Draper Associates team back in 2020, and before he was a vice president at the Blackstone Group, where he focused on providing growth financing to global energy companies. Matt got his bachelor's degree in business administration and finance from Texas A&M, hook 'em horns, but A&M has some good people as well. And now he's based in Austin, Texas. Quite a few Aggies end up based here at the end of the day as well. Where he lives with his wife and 2 daughters. So with that being said, I'd like to invite Matt to the virtual stage. Thanks for being here, Matt. How's it going?
Yeah, good to see you. Going well. How are you?
Doing well. Thanks for taking the time today. I'm excited to interview you and give some more digs at A&M. So my first question is really just to give everybody here in the audience some background on you and kind of how you got into this role at Draper Associates. But can you tell us a little bit about that journey, right? Walk us through kind of the career steps that ultimately brought you to venture capital and working with early stage companies.
Sure. So like Jake said, I graduated A&M in 2010 and went to New York City and worked in later stage private equity for about 10 years. And about halfway through that, realized that I'd always loved early stage companies and early stage stuff, but had a family by that point and knew it wasn't going to be a seamless transition. So I stuck around that world for a while longer to make more friends and put some more money in the bank. And then in 2020, decided to make the transition over to early stage via Acton Business School here in town. And started interning with Draper Associates in early 2020. I think I've always, I didn't know it, but in my mid-20s, I realized I'd always thought entrepreneurship and entrepreneurs were just the most important. It's kind of the highest calling in life, and that entrepreneurship is the most important thing, I think. And so I wanted to find a way to get involved with that. And that's very aligned with how Tim thinks about the world. And so there was sort of a good match there. And then I was able to prove that I am, worth something in a long internship in the first half of 2020. And then it also allowed me to be inside the firm and kind of get onboarded in a really nice way. And then joined in the summer.
Awesome. Yeah, I feel like I'm noticing the more I do this job, the more I kind of feel a little bit of an entrepreneurial itch myself, just in kind of how I do my job and how I think about it. Have you ever felt that? Is there anything that's ever kind of like called to you, or like tell me about your experiences with kind of entrepreneurialism?
Yeah. I do aspire to also start companies. I think I'll always be a venture capitalist, but I do aspire to occasionally start a company. It's kind of funny because I really admire entrepreneurs and aspire to be one, but I think have accepted that my natural way of being is just much more valuable on the investor side of the table. And so I'm starting here, and we'll go from there. But I so want to be an entrepreneur. I don't know if I'll ever make it. It's kind of because there is a big difference between investors and entrepreneurs, and I'm an investor.
It's really risky. I totally understand you on that. Like, speaking of kind of providing more value on the investor side of the table, how did your experience with kind of growth equity and looking at these, higher scale, higher revenue type companies, how does that translate or inform the way that you evaluate companies at the early stages?
It doesn't really, to be honest. Just because in the later stages, I think the only thing that really translates is assessing management teams. Just because in the later stages, you've just got a lot more. It's much more easy to see if something's working or not working, right? You can look at the financial statements and look at the returns on capital and look at the historic growth and talk to tons of customers, and you can go into the store for the company and try it out. But really just the big difference is you can get to the answer just by playing around in Excel a lot of the time, versus in this world. I think the big challenges in this world, they're very different. I mean, it's kind of like, what is the true market size, and what is the true competition? The competition part's especially hard for someone that's like relatively new to technology venture, just because we invest all over the world. And so and in order to invest, I need to have a pretty good sense of like the global competitive landscape. And we're generalists, so we're not experts in any one space. That's the hardest part for me, is getting a true sense for what the competitive landscape is. And in later stage, you kind of know, right? Like the competition's like right there out in front of your eyes, because they're bigger companies. So
yeah, a lot more data at the later stages.
Yeah.
It's interesting you mentioned, though, like you still kind of are able to look at management teams and use that as a little bit of a barometer on, if this company is going to be successful. That's like, it's kind of brings me to my next question, which is, have you seen any kind of commonalities between successful entrepreneurs that you worked with at kind of that later growth stage and then successful entrepreneurs that you're working with at this early stage, or does it fundamentally kind of look like two different skill sets?
They're pretty different skill sets, I think. Although there are definitely some commonalities. I mean, I think at later stage, you're dealing a lot more with managing a big group of people and managing like a much bigger capital structure. Versus, I think the big challenge at the early stages, and this is one of the reasons I wanted to, and I think entrepreneurship is so important, but it's also super hard, right? Like starting a company and growing it really fast is, I think it's the highest calling in life, and also the hardest thing you can do with your life. And so to me, the big difference as an entrepreneur founder is it's more like mental, right? Like I think taking care of your mental health as a startup founder, I think is like key just because it's so stressful I mean, this is all assuming you take venture, right?
Yeah.
Because you don't have to take venture, but if you take venture, you need to grow fast, and that's otherwise it doesn't work. And that can be very taxing, and so managing that growth, both for yourself and for the business, is very different than managing a big business that's growing 5% a year or something like that.
Yeah, definitely. And I think particularly when you take venture capital and you have all these expectations of kind of hyper growth and growing faster, it also kind of isolates you a little bit from other entrepreneurs that maybe don't have those same pressures. So yeah, mental health seems super important. Going back to kind of Draper Associates and what you look at when you're evaluating companies for investment, how do you think about that? Right? We've obviously had a couple of conversations about it, so I think I have a general sense, but for the audience, how would you explain what Draper Associates looks for in a good investment? And I'll preface this also by, guys, if you're in the audience and you have any questions, start dropping them now. I've got 2 or 3 more that I want to go through with Matt, but really the idea of this is that you guys will ask questions and it'll be kind of a true Ask Me Anything. So go ahead and start dropping those questions as soon as you have it. But I'll pass it back to you, Matt.
Yeah, sure. So we're sort of like we're like when you think West Coast VC firm, I think we check a lot of those boxes. Like I get made fun of a lot in the Texas community because we're just like true unicorn hunters, which you obviously don't need to invest, and we invest very early. So you don't need to invest in companies that are going to be worth, $50 billion if you're getting in at a $10 million valuation. That doesn't have to happen, but that's just not what we do. We look for companies that we think can be huge. And so I think, we look really for 3 things. We're looking all across the world, and we're technology agnostic, but we're looking for people creating new industries where we can get in early, which I think that's the most fun because if you make 20 bets on new industries, then hopefully 1 or 2 of them works out, and then you get a front row seat to how that industry develops and where the other good investment opportunities will be in that new industry. And then the second, we'll be pretty price sensitive for those investments, just because it's not clear anyone's going to win when it's a new industry. And then we'll invest a little later stage when maybe the industry's been around for 5 or 10 years and people have been competing, and now it's clear that like one person is going to win. We would love to invest in that company, and we'll pay up for that. And then the third, we're always looking for really good management teams, but occasionally we'll back. I mean, it would never be just backing a team. It would be like a team that's like, maybe we've backed them before and we know they're great entrepreneurs and like they've got a prototype and some interest or something. Or occasionally we'll come across someone that seems to have like a Bill Gates, Mark Zuckerberg type story where it's like they dropped out of college, they've got a cool product, and they're really visionary people. Sometimes we'll back those people. And then we usually invest at the seed stage and lead deals. And then on top of that, I've got my little sheet here that's going to come through backwards. But this is what I use when I'm talking to entrepreneurs, and it's really tailored to me because I'm like a super optimistic person who sees the upside in everything. And so my sheet is all about risk, because without that, all I see are the good things. So it forces me to think about the 4 main risks in an early stage investment, which curious, Jake, if you have any input into this, but I would view them as competition risk, market risk, technology risk, and execution or team risk. So I'm just trying to think about like how much risk, like how much it forces me to think about how much risk we're taking, because these are investments, and so it forces me to not do what I would do naturally, which is just see like, oh my gosh, this is going to be huge if it works, and then you're like, wait, the technology is totally unproven. They don't have a team yet. And then just some like, market size is really important to us. We like to see at least, I mean, it depends on the situation. If the company is like very, very early, then we like to see like at least a $2 billion market, if not like a much bigger market. And then sometimes we'll invest in companies that like are the clear winner in a space, but the space is smaller. Mm-hmm. And then business model, marketing channel, traction, financial history, vision, long-term vision for the company, and then just like why does the founder care about this? And I think the the why question is really important to us. One thing we're big on is, in the VC model, especially in the very early stage, if you make 10 investments, 5 will probably go nowhere, 3 or 4 will be like 5 to 10x, and then like 1 or 2 will be, the big ones. And it's really how big those 1 or 2 are that determines how the fund does relative to other funds. One thing I didn't realize, though, is that those 1 or 2 that end up being the big ones, it takes 10 years for companies, for founders to go from, start from taking our money at the seed stage to like actually being like truly like wealthy people, like not just paper rich, but actually rich. And so we look a lot for signs of persistence. Like, is this person, like, we don't want to invest in people that are going to sell their business, at Series B or C. And I'm not saying that it's bad to sell your business at Series, like there's a lot of people, a lot of money out there for that kind of investing. But we're looking for the guys who want to like ride this to the moon and be worth $100 billion kind of thing.
Mm-hmm. It's interesting. I like that framework that you showed of the different types of risk. When you talk about market risk, is that as in like the risk that the market might not be big enough to where you would want to invest, or is it more like kind of market timing or of, this is cool technology, will it be kind of mass adopted?
Yeah, I think it's both of those things. It's size of market, timing, and then for a lot of the companies that we deal with, it's also like, is there a market? This person is doing this crazy thing, and like it's not gonna be ready for 5 years. Like, is anybody gonna want to buy it when the time comes? Like, do we think that do we think that the world that will exist will have buyers for these products? Because we deal a lot in like frontier technology where there's just, it's not like you're taking maximum risk. Like, it's not clear that who's going to win, if anybody's going to win, if there's a market there, and all. So it's like maximum risk.
Yeah, but when it works, it's world changing, which is super cool. Yeah. Awesome. I think my last question, and then we'll jump into some of these audience questions, would be, what are some common mistakes you notice when some of these early stage founders are pitching you their companies? What kind of advice would you share to help people get better at that first initial meeting?
I think it's always good to, for me, in my particular job, the important meeting is the one with Tim. So you'd meet with me first, and then I meet with companies all day, and then I tell Tim about the ones that I think he'll be interested in, and then he and I would meet with the company. So when companies are pitching me, it's like it's usually pretty casual and much less time constrained. And so I don't know that I've noticed anything when pitching for me, because like the things that I need to know, I have time to ask at the end. But on pitching in general, on pitching to Tim or people like Tim, I think most people do this, but some don't, reaching out just to ask, like, what's the format of this thing? Because some people get on and they assume that I've told everything that I've told Tim everything they've told me, and that's just that in a perfect world with infinite time that would be the case. But it's just in this case, it's like, hey Tim, this company does this, they've got this much traction. Do you want to meet them? Yes, no, move on. And then a month later he meets with them. So I think for us it would be start from the beginning. And I think one mistake I think companies make sometimes is not telling their traction until the end of the call, because sometimes we'll be on a call and you can kind of tell Tim's like, this person is crazy, like what is like this, like we'll catch this company next round, like this doesn't seem, or like this is, we've talked to 100 companies in this space and they're all pre-revenue and none of them are working yet, this is just another one of those. And then at the end of the call, the company will be like, oh yeah, by the way, we did like 20 million of revenue last month. And then Tim's like, oh wow, okay. So I think that kind of stuff is always good. And then Tim always asks the same thing I mentioned earlier, like, why do you care about this? And that sometimes that's a very direct, deep question that we're not used. You're not used to getting asked in a professional setting, I don't think. So sometimes not ready for that question.
It's a really good question, though, especially with kind of the types of founders you're looking to back that are like industry creators.
Yeah.
Yeah. Awesome. Well, let's start diving into some audience questions. Keep them coming, guys. We got 40 more minutes of this. To start off, it looks like we got our first question from Shelly Chin. And Shelly asks, how does Draper work with entrepreneurs after the investment?
Yeah, this is such an important question, and I should have said this actually when I said stuff that can be when you're pitching. It'd be more to ask me. Sometimes entrepreneurs like grill Tim on like the value he's going to add if they invest, and I'm not sure he's the one to grill about that. But he always handles it so kind of graciously. He's a really impressive guy. But so I would ask this to every fund that you work with because this is such an important question. So for us, our sort of ethos is that entrepreneurs are superheroes, and we're trying to find the entrepreneurs that want autonomy and don't want an activist VC. That doesn't mean that we're not here for you whenever you need us, but it really means that like we'll be as involved as you want us to be, which can be zero or it can be a lot. So I think our thinking is, other than like a monthly, I guess like a monthly email update and a monthly call, beyond that, it's kind of up to you, like how much you want us to be involved. And, our strategy is to make a lot of small bets. And so our ethos of like kind of give the entrepreneur money and let them be who they are is also sort of forced on us because there aren't that many of us and we have a lot of portfolio companies. So versus, I think any fund you talk to, if they're not, I mean, it's just human nature. If they're not making a lot of investments, then they're going to be super involved in what you're doing. And that, again, that's not good or bad. Just depends on what you want.
Yeah, makes sense. I think that's good advice in general when interacting with investors. Like, if you want their help with something, just make that specific ask. And I feel like there's very few investors that'll be like, oh no, we can't help you with that. They'll kind of try to lean in and help. But yeah, that is some good insights to kind of how you think about things and how you work with entrepreneurs. Next question comes to us from Clark Jacobs. Good to see you, Clark. Clark asks, when you say seed stage, can you describe how early you typically get involved? Basically the traction question. What kind of traction are you looking to see?
Yeah, it varies a lot. And I think, our bread and butter is to lead seed stage deals as defined by the West Coast. But we can do a lot of other things. Like I think we have a 20% allocation to other. So like I think we actually own like a decent amount of crypto in the fund, for example. So we can do a lot. And like we just made a 200K investment in a Series B company, and we're buying 300K in the secondary market for a company that's worth $200 million. And so we're like major followers in that investment, not leading at all, just like the company a lot, like the team a lot, and they're doing great. But in terms of what we do most and what we do best, it's leading at what we would define as the seed stage. We typically define that as team in place, product in place, and some form of traction, ideally revenue. Since we're global and we're generalists, that's kind of like the nice way of saying we don't know a lot about anything, but we know a little about a lot of stuff.
Mile wide and inch deep.
Yeah. And so revenue and like real customers like really helps us because we get approached with really weird stuff. And so being able to be like, can we, like, I don't know what you just said, but you say you've got some customers. So can you just introduce me to them? And I can ask them like, what is going on here? And are you paying for it? And how much are you using it? And do you love the product? So I like some form of traction is generally pretty important to us for that reason, because it helps us figure out like what really works and what people really pay for. I would say our average revenue size, I'll give you a range because I don't know exactly what the average is, but like it's probably like 25K to 150K monthly revenue, like in that strike zone. But like we've gone pre-revenue. I mean, there's certain industries where like healthcare is a big one. where you can have a lot of traction and still be really far from revenue. But I would say, handful of customers, good amount of, and it doesn't have to be recurring, but these days most technology companies do have a recurring business model, but that's not necessarily a requirement. And things that we wouldn't do, like we'll never fund a team that's not full time. We'll never. That's probably the only. There's a couple other things that we'll never do, but that's probably the main one. Like you got to be full time, you got to have a product, or unless it's like one of the truly crazy ones. Like we just funded a crazy awesome ones. We just funded a business in Houston called Venus Aerospace that is going to build a kind of a rocket plane that can take off and land on regular runways and fly from LA to Tokyo in an hour. But that product won't be done for a couple of years. But that kind of met the threshold of investing.
Yeah, it's like Capital Factory. We call it an exception for awesome, and that seems to very much be in that category. This next question is kind of just for me, but it's based off of what you just said. Draper is built to lead seed rounds as defined by the West Coast. I'm curious, now that you've been in Texas a little while and you're seeing more deals that are coming from Texas, what are some of the key differences that you notice between, deals out in, the West Coast, San Francisco, and deals that you're seeing here in Texas?
I think that it's kind of funny. The average sort of risk return opportunity in venture probably shakes out pretty even, but it's probably pretty skewed in the West Coast to like moonshot type stuff, and then in Texas you see a lot more like great businesses, very unit economics focused, like great entrepreneurs, but not necessarily thinking as big. I think that will change over time, and it'll be a really great mix of really great entrepreneurs thinking really big. And I think that's one of the most exciting things about the Texas market is there's like the quality of entrepreneurs in the Texas market is super, super high. I think the tendency to say things like, and then to say things that we don't want to hear, which is like, and then we can sell at this point, or here's the companies who are going to buy us after our Series C or whatever. Like we don't want like that. There are a lot of investors who want to hear that. That's like we don't want to hear that. We don't want to. If you're already thinking of selling, then we're not going to invest. Basically, it doesn't mean that you couldn't make a ton of money and that you could make a lot of investors very happy. It's just a different strategy. Mm-hmm. So that's probably the biggest difference. I'd say the quality of entrepreneurs seems higher to me, but the sort of desire to build, massive world-changing companies is bigger on the West Coast, I think.
Yeah, I think I'd probably generally agree with that. And honestly, like one of the things that excites me so much about having investors like Draper Associates, like you, like some of these other West Coast firms that are now paying attention to Texas is that it's a little bit of the chicken and the egg problem, right? We might have these entrepreneurs that have these big moonshot ideas, but they know that to raise funding to, actually go out and execute on them, they've got to kind of go to the West Coast or go to Silicon Valley. And, I'm hoping that having more investors like you guys that are willing to kind of take early risks on these moonshot ideas, that'll ultimately lead to more people pursuing those moonshot ideas here in Texas. So it all kind of feeds itself. It's a little bit of a virtuous cycle, if you will.
Yeah, I think it'll be good. Like if you for a lot of our companies, like if you came to us, say we invested you at like a 10 million valuation in the seed round, and then you came to us, between your Series B and C and said, hey, I've got an offer for $200 million. Like, I think I'm going to take it. We it depends on the situation. Like at that point we would have seen the business for a while. Mm-hmm. But generally we're gonna discourage you not to do that, right? Like we're gonna because assuming everything is like played out as we thought, right? Like no, like you're like we invested in you because we think you can take this thing like to the moon. Mm-hmm. And so hopefully that'll help for people that want that, right? Like that's not for everybody. I'm not sure, to be honest. I'm not sure what I would do if I got a big offer like that. And then it's part of why I'm on this side of the table, I think.
I feel very similar. When I talk to companies too, and they ask me like, should I raise VC funding? Should I find other routes? That's one of the things I ask them is like, do you want to dedicate your life to this? If you get a really attractive offer, like, is this something that it's not good enough, right? You want to go and really take this to the moon. I think that's just kind of a fundamental difference between, investing in just moonshots and just generally kind of trying to make good investments.
Yeah.
All right. So coming back to some of the questions we're getting from the audience, and guys, keep them coming. These are really, really great questions. The next question comes to us from Zeke Torres. And Zeke asks, what user traction are you looking for when investing in early stage companies? So I guess this is probably more consumer focused businesses.
Yeah. User traction. So is that like number of customers, or like I guess there's like a million ways you could answer that. It really depends.
Yeah. Monthly active users, things like that, maybe.
Let me pull up a memo and talk about one we just made, and I won't say the name.
You guys have a ton of really, really great consumer companies too. Things like Robinhood. Were you guys investors in Coinbase?
Yep.
They just released their quarterly earnings a couple of days ago. Those look really, really impressive and good. And
one of the funny things about this joining a company with this investment strategy versus joining like a later stage investment company is like we've got 600 portfolio companies like across the Draper world, like across funds. I mean, in the fund we're investing in now, we started investing like mid last year, and I haven't looked recently, but it's probably got like 20 or 30 companies in it. But so that's all to say that like I don't know really anything about like some like there was no opportunity backwards and like learn the companies we've invested in the past just because it's overwhelming. But so it's really only the companies that we've invested in the last 8 months, and specifically the ones that like I was on the team for and I'm on the board of, that I'm particularly close to.
So it's not often I talk to an investor with a bigger portfolio than Capital Factories, like at this point almost 500. And I totally understand. When I first joined the team, it was like, how am I supposed to learn all these 300 companies that came before I started? So it's definitely been a learning process. I feel your struggles there.
Yeah. Let's see here. So this company had 93,000 user accounts, and they were a platform that had a product that sells a product, and about 50% of their users had purchased the product since inception, which is about 4 years. User accounts have been growing monthly at 13% in the last 12 months. They get 3,826 unique visits per day. And the unique visits have been growing at roughly 5% per month, or 35% in 2019 and 70% in 2020. So I think it varies a lot for every business, but that's an example of a business. That was an example of a really, really good business that's in a sort of a small market, but it looks like they're going to be the winner in the market. And they could find their way to much bigger markets and be a really big company if things play out, in certain ways.
Adjacent opportunities, and it's a good way to benchmark it. Awesome. The next question is a great question. This comes to us from Steve Flaherty. I hope I pronounced your last name correct, Steve. Steve asks, seeing as Capital Factory has a relationship, are you analyzing AFWorks companies and like the new SBIR, STTR model, and what that kind of brings to the startup world? For audience members that aren't aware, SBIR is the Small Business Innovation Research Grant, and STTR is something to do with technology. I don't know what the acronym stands for, but essentially these are like rapid contracting mechanisms for the government to provide non-dilutive funding to early stage companies. But yeah, how do you kind of think about, some of these, dual use types of technologies and opportunities?
Yeah. I think I don't have a lot of stuff I've heard Tim talk about, and I can give Tim's answer. I haven't heard him talk about this, but I think I know enough about how he thinks about the world to answer. So I think, the non-dilutive funding is great. That's one thing. I think we always like to see that. One place we may be wrong or stale on or we may be right, I'm not sure, is that we generally don't like the government as a customer, for a variety of reasons. So it would have to be a true like there would have to be true like dual use traction for us to be really interested. I've talked to a couple of companies recently that make me think that a decent amount has changed especially in the military complex around this stuff. That makes me kind of think maybe we need to revisit that opinion, that the government's not a customer we love. But so I think we just made an offer to a company that's in what's it called? They're doing the Air Force's deal. Let me pull it up. They're in
probably AppWorks, maybe an SBIR.
Yeah, it's SBIR, I believe. So just for everybody's reference, what I'm pulling up is we try to write like a 3-page memo on all of our investments. So that's what I keep pulling up to just glance at this stuff. So here it is. So they're in the Air Force's. Yeah, they're about to be eligible for Air Force's TAC-5 program, which means they're in phase 2 of the SBI. I believe it's the SBIR deal. So they've got 21 customers, and it's like a pretty strong mix of industry customers, academic customers, and government customers. So I think that that's an example of a situation where they're in the program, they're benefiting from it. They're doing great work for specifically the Air Force, but they have customers outside of the government.
Yeah, that makes sense. Well, one interesting trend that I've been noticing is that some of these companies that are working on like truly innovative types of technologies, like moonshot ideas, they kind of understand that it's going to take a lot of development and funding to get to the point where they could, either commercialize it for the mass market or begin distributing it and getting it in the hands of consumers. So they're actually viewing the government and some of these non-dilutive funding opportunities as a way for them to kind of bootstrap that R&D to get it to the point where they could get it in the hands of the mass market and in the hands of consumers. So I just think it's a really interesting strategy.
What do you know, like for the programs that Steve is citing here, are they new?
I know that they have kind of revamped them in the past couple of years. They founded the Army Futures Command along with the Space Force. That was something that happened, I want to say, in early 2018. And that's really what led them to kind of look at the SBIR program and figure out how they can make it easier for startups to access. The STTRs I'm actually not as familiar on. But guys, if you got any context, drop them there in the comments below. Yeah,
I'm just curious. Tim's actually here in town next week, and I'm wondering if I should talk to him about this view of government as a customer.
Let's connect after this. It might be good for him to talk to somebody that's actually managing some of these programs to get how they think about it.
Yeah. Awesome. We're actually in this fund. We're not really thesis driven, but in this fund, our view is, this is obviously not a political broadcast, but I'll do it anyway. Our view is that pretty much everybody in the world is unhappy with their government today, and so we're looking for companies that good governments will partner with, and bad governments won't partner with. So like companies that are in some way really good for the country's citizens, the good governments will partner with them, and bad governments won't, and that will drive people in different directions and make good governments more influential. And then also what's called DGov, or decentralizing government activities, where I'm talking to a company now that's in the water business, and would decentralize the government activities in water, just provide the service better and cheaper and faster and all that. So
yeah, interesting you say that. Back when I was in college, I had to do a couple of business plans, and every time I was actually a government major, so I was really interested in kind of this aspect of things. I would always pitch like a blockchain voting company, because it just seems like such a natural kind of fit.
Yes, yeah. I don't know. Yeah. It seems like maybe it's too high tech it's probably too high tech for me.
Yeah.
But it makes a lot of sense. Maybe one day.
Yeah, somebody in the audience, go build that. That's a great startup idea. Just give me a little bit of credit. Next question comes to us from Zeke Torres again. When looking into the team as a risk, what is your criteria? And I guess I'd flip that. When looking into the team as kind of an asset for the business, what are you looking for? And the second half of that question is, do you want to see an advisory board in kind of like a seed or pre-revenue company?
Yeah. So team. I think one thing, maybe I should have said this earlier. It's not really a mistake startups make, but I think if you think you've got a good team, then get your whole team on the pitch. I don't know. I've never worked in a startup, so maybe that's not feasible. Like maybe you're too busy to have everybody on there. But like if it helps us a lot to analyze the team, if we can get you in an environment where it's a formal pitch for 15 minutes, but then the next 30 minutes it's like more informal, and you're having to like talk over each other, and you're disagreeing, and like personalities are coming out a little more. It's really helpful for us when the whole team, and it's also very rare that the whole team joins. So that's another way to like differentiate yourself. I think we look for like a business founder and a technical founder. The business founder can doesn't need to have necessarily like super specific experience relative to the startup that they're doing. Like, it doesn't need to be like right down the middle. Like, they're doing a blockchain startup, and this guy has blockchain. It's more like, can he sell? Does he understand cash flow?
Mm-hmm.
Is there like a good business mind there that knows how to think about growing companies? It's probably like more experience with this business model than there is like with this particular product. But for the technical founder, we look for like very specific experience as it relates to like what they're doing now. Like, and we focus a lot on like, does this team have the technical skills that they need to do what it is they say they're going to do, or do they still need to hire it? But that's probably the main thing, in terms of the like, co-founders, business and technical, and then probably back to that persistence thing. Like, do we think this person will persist for 10 years, or will they flame out, or will they sell? So that's probably a lot of what we're looking for the team. And then the advisory board thing, we never talk about that. It never really comes up, like who's on the advisory board. Probably because, it may come back to our strategy. Like, we're very high volume. So we look at a lot of deals. We talk about a lot of deals. We invest in a lot of deals. And so advisory board, and maybe it's important, but it's like, it's at secondary to us at best, just because it can be faked, right? Like, you can put anybody you want on your advisory board slide. It could also be that it's kind of like patents to us. Like, we actually don't. It's a little bit of a check the box. Like of course you need an advisory board, and of course you need a patent. Like, we don't care. Really, all those things are, especially patents, are like I think we view them as like a necessary evil almost, because your biggest risk as a startup is that you're going to run out of money, and patents cost money. So anyway, I've never in the 8 months I've been with, or 9 months I guess I've been with the firm, I've never heard anyone talk about an advisory board one time. So that tells me that it's probably not important to us.
Yeah, interesting. Yeah, and I guess it makes sense, like, especially with your strategy of kind of being hands off, except where people want you engaging. Like, the advisory board's not going to build the business for you, you know? So I kind of understand why maybe you guys don't put too much weight on it.
Yeah.
Great question, Zeke, by the way. This next question comes to us from Olivier Breton. Hope I didn't butcher that name either. Olivier asks, which industries are you most interested in investing in 2021 and beyond?
I mean, for us, it's the ones that aren't invented yet, right? Like it's like that. Like if you're trying to create a new industry, so I can't really give an answer on that one because I don't know what it would be. But I think the government stuff I mentioned earlier, I think if you think of the world as just a bunch of customers, and you think everyone is unhappy with their government all over the world, then you've got a bunch of unhappy customers looking for alternative solutions. That's one thing we're looking for, and not finding a ton of it. So yet, at least. So I think we're like looking to take. I mean, everything we do is super risky, but in terms of like where we'll take the most risk in this fund, it's probably in that government related bucket. And then, our flag is still planted in crypto and blockchain. It's been there for over 10 years now. And so crypto seems like pure crypto seems like it's kind of not frontier anymore. A lot of blockchain still is, so we're still evaluating a lot of blockchain stuff. And it's hard. Like there are some interesting use cases out there. But a lot of them are pretty competitive, and like a lot of them assume a pretty big behavioral change. So we're watching a handful of them to see kind of how they launch and all that stuff. Mm-hmm. So I'd say those three buckets. Like one is industries that don't exist yet, two the government related stuff, and then crypto and blockchain.
Yeah, there's a company you should take a look at from Capital Factory called Civitech. Kind of firmly in that government space. I'll talk to you about that offline, but this is kind of a personal question just because I'm kind of interested in blockchain. What are some of kind of the use cases that you feel haven't really been fully explored yet? I know that, NFTs, those have recently become really popular. That kind of seems like a logical progression out of, having kind of smart contracts and a centralized ledger of transactions. So I'm just curious, like, do you have any ideas of kind of other use cases that you haven't really seen go mainstream or blow up yet that you think crypto's or blockchain specifically, that technology is kind of particularly suited for?
Yeah, I think the big one for us, the thing we're seeing a lot of right now is digital identity, and like self-sovereign identity, or SSI. There's a lot going on there, and it'll be very interesting to see how it plays out. I think it seems fair to assume that, maybe 10 or 20 years from now, basically all of our credentials will be digital. I mean, think about that. That could be huge, right? Like, think about, I didn't really realize it until recently, but basically all of our pre-professional lives, all of the data from that part of our life is effectively fully analog. Meaning that if you want to get your college transcript, I haven't tried in a while, and there is some progress, but if you want to get your college transcript, you have to pay like $47 and they send you a PDF, right? Mm-hmm. Like the idea that that's not like all digital with like a million apps and models running on top of it is like crazy, and in terms of like the impact it would have on productivity. Like for me, I feel like I found what I was meant to do. Roughly in the venture capital world, but it took me 12 years, right? Like if someone had been running a model on my pre-professional life, I wouldn't have had to take 12 years to get to where I'm like optimized in a way. Mm-hmm. So I think all of our credentials will be digital, and we'll hold them in some form of a digital wallet. And the question is like, how will those things travel? And it sort of has to be a blockchain for it to be like secure and all that stuff. I think. And so the big question is, is it going to be a decentralized blockchain or a centralized blockchain? Is the government or our government's going to be super involved in it? Is it going to be run by one company or one government, and then like there's a big question on like who will actually own and control your credentials? Will it be you? Will it be the issuer? And it will have pretty big impact on freedom, I think, actually, levels of freedom, like how that plays out. So anyway, there's a lot going on in the self-sovereign identity world related to blockchain.
Yeah, what that makes me think of is we've got like these password managers, right? A lot of them have us installed on our browsers or something. Why isn't there just like kind of a centralized identity manager, like I guess self-sovereign identity that has your credit card numbers and maybe your tax information and your passwords for websites, and then you kind of just give your key instead of your password to log into things. That's really interesting. There's a lot of stuff there.
Yeah, but that's actually, I think that space is turning into a space where we're probably just going to wait. An example of the second bucket I mentioned earlier, where it's like there's a lot of competitors, even for the primary layer blockchain, there's a lot of competitors in the self-sovereign identity world, much less like all the services that will form around that. And so far we've looked at a handful of companies, and it seems like our approach is going to be to wait and let the winner emerge and then invest in the winner as an example of when we do that.
Yeah, definitely. I think there's probably 3 or 4 Capital Factory companies that are working on some aspect of that problem. Well,
I think awesome. It'd be interesting if someone has like a picks to gold miner strategy for self-sovereign identity, that could be an interesting investment.
Yeah. Awesome. Well, I think we have time for one more question. So I'll ask one more question and then kind of hand the mic off to you to tell people, basically just to promote whatever you want to promote and tell people to get in touch with you. But this question came to us from some of the audience that registered ahead of time. And I think it's a really great question. Really just kind of want your input on what you think about it. When is the right time to pitch investors? And they put right time in quotations, I think, because that's really kind of a tricky, loaded question. But, what do you think is really that good inflection point at which you're kind of ready to begin engaging with specifically venture style investors like you and Draper?
I mean, so engaging with me, it'd be different question if you're talking about Tim. Okay. Especially if you're in Texas, like engage with me anytime. Like I'm here for you to help in any way. The one thing that's been funny as a sort of new venture capitalist is there's an interesting view of venture capitalists out there in the world, and that like people think that I can do a lot of things that I can't do. So like I'll get approached with like people approach me with like just an idea, and they'll say like, how do I do this? And I'll be like, I don't know. But I do have like a one pager that I can send to people that says like, I don't know the answer to this, but these are all of our resources to help you figure that out. Like Draper University as an example, or there's like Draper TV with a lot of curriculum on there. So I mean, engaging early is great, right? Like it's better for everybody if like we know each other when you actually need to raise the money and we have some history, and I kind of know where things were and how you got to where you are, and same for you about me. In terms of when you should actually raise, which is what I think the real question is.
Yeah.
It's a really good question. I think this is sort of cliche, but the answer is like when you've got product market fit. And the reason for that is you really don't want to spend like venture capital money. If you're not going to grow super fast, venture capital money is really expensive. And you can't really grow until you can't like have sustainable growth until you have product market fit. And so like you really, really don't want to spend expensive venture money figuring out who your customer is and like what they'll pay for your product and how many of them there are. Like you want to raise the venture money when it's, it's kind of like when you've got the fire going, right? And like you know what it is that makes the fire, and now you just want to make the fire bigger, quicker. is how I think about it. So like once you know, like I don't think you'll ever know these things exactly, and it's always hard to take that leap. But I think once you know who your customer is, and what they want and what they'll pay for it, and like how many of them there are, then and like that all makes sense as a business. Then that's when raising venture capital makes sense. And I think especially if you're in like a competitive environment where there's like network effects to get and things like that, and you want to move fast.
Mm-hmm. Grab a lot of market share. Yeah, and I think just to like kind of wrap that in a bow, the way we describe it, or product market fit specifically, is do you have a scalable, repeatable sales process, right? Because once you've hit that, then it becomes, to use your metaphor, you're pouring fuel on that fire that already exists. What is that fire? It's a scalable, repeatable sales process with an easily identifiable customer and a market that you kind of understand what the landscape looks like.
Right. Yeah, totally. And I think that another thing to add is that I don't think most of us, like I haven't experienced this yet. I've experienced, since I worked in energy between 2010 and 2020, I've certainly had my experience with cycles more broadly. But in terms of venture cycles, I don't know. I don't even know when do you think the last downturn was in venture?
I was kind of expecting one last year, but it didn't really seem like it happened.
Yeah. So that's the other thing I would factor in, is that like venture funding is supposedly extremely cyclical, and can dry up. So right now that's not the case at all. Venture, like I would say, venture is almost commoditized right now.
I want to say it was like $125 billion in venture investment in the last quarter.
Right.
Which is insane.
Right. So there's also a component of, raise when you can and just don't spend it kind of thing. Just because it is cyclical and the tap can run dry unexpectedly, and that may be right when you need the money. So I think Tim always tells founders, and he's explicitly telling founders at this particular moment, like, raise as much as you can, just don't spend it. Because who knows where we are specifically in the cycle, but it's definitely like a high point.
Yeah. Awesome. Well, Matt, thanks so much for your time today. These were great questions. It's always good kind of hanging out with you and get your input on things. Before we go, I do want to kind of hand the mic over to you. I think Draper, the Draper Startup House has some event going on next Tuesday. Really just kind of want to give the mic to you if there's anything you want to promote, or you want to give people a way to get in touch with you. The floor is yours.
Yeah, sure. No, this was great. It's always good to hang out. I think it sounds like I'm going to see you a couple times in the next week. So that'll be fun. But yeah, on the Draper Startup House side, that's a different part of the business than me. But we're open, and yeah, there are a couple events next week. But that's Katie and Daniel's turf. I'm sure that's like all over their social media if anybody needs to see anything.
At Draper Startup House, check it out. I got you.
There you go. I'm just doing deals here. And then yeah, for me, I wear a couple hats in the firm, but probably the biggest hat is developing our presence and our kind of pipeline and portfolio here in Texas, and with Texans. So my email is matt@draper.vc, and I'll take I'll meet with anybody that's a Texan. Like even if you're just in the idea stage, or even if you're way later stage, Texas is the ecosystem that I like really care about. Beyond just like earning returns for our fund, I actually care. Like I care about the Texas ecosystem. It's not necessarily true for the whole world. Like from the world, I'm looking for returns, but for Texas, just looking to make friends and help people. So Matt at draper.vc, and I'd love to chat anytime.
Awesome. Well, Matt, thanks again so much. This was great. Everybody in the audience, we do these every second Thursday of the month at this same time. So we'd love to see you next month. And yeah, everybody have a great Thursday.
Cool. See you guys. See you, Jake.
See you, Matt. Talk to you soon.